Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, Professor of Economics at Ewha Womans University. Professor Kim, always good to have you on. Thank you.
Good afternoon, Devin.
Well, the IMF has lowered its growth forecast for the global economy this year by another 1.9% from its previous forecast in April, and for Korea's, it's cut it by another 0.9%. Of course, both figures in negative territory. What's your view on growth for this year?
In this World Economic Outlook update, the IMF further cuts global economic growth forecast down to negative 4.9%. This is almost 2%, exactly 1.9% more cut compared to that of April's forecast from IMF. I think they see worse than expected economic outcomes in first quarter and a more pessimistic situation in the second quarter. Meanwhile, the IMF predicted Korea will post a contraction of 2.1% this year, which is 0.9% down from its earlier outlook in April. However, among developed nations, Korea posted the highest economic growth, which is slightly above the average figure of developing nations.
Well, meanwhile, in the pandemic, the WHO is saying that by next week, the total number of confirmed cases worldwide will reach 10 million. What effect does a number like that have on the global financial markets?
As coronavirus cases are accelerating in U.S., up to 36,000 infections per day, U.S. stock market tumbled with negative 2.6% in S&P index yesterday. The same situation is heavily dominating European and Asian markets over yesterday and today. In European market, London, Paris, and Frankfurt markets had about negative 3% return this morning, and Nikkei and Hang Seng had negative 1.2% and negative 0.5% respectively today.
As you say, stocks on Wall Street down sharply overnight, almost 3% in the case of the Dow. What's the story in the other markets?
Today's domestic market is much affected by foreign markets' low performances of yesterday. Today, Kospi ended up with negative 2.3%, and Kosdaq also had negative 1.2% today. In domestic market, individual investors bought stocks, but foreign investors and domestic institutional investors sell the stocks today.
It was a good run there for the Korean markets for a while, though. The Korea Enterprises Federation, which represents business, of course, has outlined some policy directions for helping out the real economy, not only recover from this pandemic, but even make a leap forward in the future. What are those measures, and what effects might they have?
Korean Enterprises Federation released a report that urges more aggressive role of government through reconstructing economy into a business-friendly environment. The report predicts worse than government expected market situation and bankruptcies of more private corporations. And the report ends with providing three policy proposals of improving private sector's vitality, like establishing efficient income distribution system and securing sustainable physical resources. And these policy proposals are kind of much agreed with many economists.
Now, we see in April here in Korea, the number of babies born was down from a year earlier by 10%, and births were again outnumbered by deaths. A shrinking population clearly affects the economy's potential growth. So what can be done about this?
One of the most unfavorable and unexpected damages to economy from COVID-19 is population effect. We are experiencing abrupt economic recession due to COVID-19, but technically speaking, it has a short-run effect because our economy will be recovered by the end of next year, for example. But COVID-19 has a force to decrease number of marriages, number of new births, and to increase number of deaths, which is already reflected in April's population decrease in Korea by 1,200. So in the longer term, COVID-19's effect is much longer than we think. So there should be more aggressive policies from government for avoiding this problem.
It's a problem indeed, Professor Kim. Thanks so much for sharing your insights today. We appreciate it.
Thank you very much.